All right, if you've been keeping an eye on the markets this year, you've probably noticed something kind of weird. It's really been a tale of two completely different stories. And, if you happen to own both stocks and crypto, well, you're staring at a pretty interesting tax puzzle. So the big question is, how do you find a silver lining in those crypto losses? Let's get into it.
So check this out. This chart pretty much says it all, right? On one side, you've got the S&P 500 just having an awesome year, up something like 18%. But then you look at Bitcoin and it's down about 5%. Now, this split, this exact divergence, that is the key. It's the whole setup for a really powerful tax strategy we're going to break down.
Okay, so we're looking at a tale of two assets. I mean, when your stocks are doing this well, that's fantastic news for your portfolio, obviously. But there's always a but, isn't there? It comes with a pretty big string attached. You are almost guaranteed to be looking at a pretty hefty capital gains tax bill.
Yeah, it's that classic good news, bad news scenario, right? You're popping the champagne for your stock portfolio, but then reality hits. The tax man cometh. And all the while, your crypto is just sitting over there in the red. It can really feel like you're getting squeezed. But what if? What if you could make those two things work together?
And this is where we find that silver lining. There's this incredible strategy that lets you take those really frustrating losses and, believe it or not, turn them into a major advantage. You can actually use them to lower your tax bill. And this whole thing, it's called tax loss harvesting.
So what is this thing exactly? Well, to put it simply, tax loss harvesting is just selling an investment that's down. You're doing it on purpose to realize that loss, to make it official on paper. Why? So you can take that loss and use it to wipe out the gains you've made somewhere else.
And the process itself is actually super straightforward. Step 1, you sell that crypto that's underwater. Step 2, you take that loss and use it to cancel out your stock gains, literally dollar for dollar. And the result? Boom, a lower tax bill. It's a really direct way to turn a portfolio negative into a tax return positive.
Okay, but you might be thinking, what if my losses are way bigger than my gains? Well, the IRS has thought of that too. You can use up to $3,000 of those extra losses to lower your regular income, your salary, which is huge because that's often taxed at a much higher rate. And if you still have losses left over, no problem. You just carry them forward to use in the years to come. Now look, this whole tax loss harvesting thing, it works for stocks too. But when it comes to crypto, there's this weird little quirk in the rules. Or maybe it's more of a lack of a rule. And it turns this whole strategy into what is basically a financial hack for anyone investing in digital assets. Okay, and this is the absolute key. For stocks, the IRS has this thing called the wash sale rule. And what it means is if you sell a stock to get that tax loss, you are forbidden. You cannot buy it back for 31 days. It's like they put you in a penalty box. But, and this is the big but, because the IRS currently sees spot crypto as property, not a security, that rule, it just doesn't apply. So this is where the hack becomes a total game changer. I mean, listen to what CPA Robert Persichetti says here. You can literally sell your Bitcoin, lock in that tax loss, and then buy it right back on the same day. Think about that. You get the full tax benefit, but you never give up your position in the market. You don't have to worry about missing a huge rebound. And this is a big deal. According to Will Kong, a finance professor at Cornell, that ability to do it instantly, that harvest and rebuy, is exactly why we see this massive flurry of activity right at the end of the year. Stock investors have to tiptoe around that 31-day window, but crypto folks, it can just pull the trigger the second the timing is right. So because of this really unique advantage, what used to be kind of like a niche trick for in-the-know investors, well, now it's becoming a much more sophisticated, planned-out part of a serious investor's overall strategy. Yeah, financial advisors are seeing a major shift in how people are thinking. Investors aren't just treating their crypto like some isolated gamble anymore. They're deliberately using those crypto losses to cancel out gains from everything else. Stocks, private investments, you name it. And they're doing it as a core part of a really smart year-end tax plan. I love how financial planner Tom Jogahegan puts it. He says his clients are just more deliberate and informed now. They get it. They understand how it works, and they're using crypto as this really flexible, really powerful tool inside their entire financial picture. It's not just some side bet anymore. But, okay, here's the catch, and it's a big one. As powerful as this advantage is right now, the regulatory world is starting to catch up. The rules of the game are definitely getting tighter, which means this, let's call it a loophole, well, it might not be open forever.
And you can see the direction this is all heading. The IRS really started cracking down on reporting way back in 2018, but the real game changer, that's coming in 2026. There's a brand new tax form, the 1099 DCA, and it's going to force exchanges to report all of this stuff directly to the IRS. That means way more scrutiny and way less room to, make mistakes. So here's the bottom line. Just as investors are getting way smarter about using this strategy, the regulators are getting smarter about tracking it. This tax loss harvesting hack is an absolutely powerful tool, for now. But it really leaves us with a huge question hanging in the air, doesn't it? Is this amazing crypto tax advantage living on borrowed time?